Coming up next, it's Bob Chapman, the international forecaster.
In 1972, a crack commando unit was sent to prison by a military court for a crime they didn't commit. These men promptly escaped from a maximum security stockade to the Los Angeles underground. Today, still wanted by the government, they survive as soldiers of fortune. If you have a problem, if no one else can help, and if you can find them, maybe you can hire the A-Team.
Well, you know, Bob, before the housing smash gained momentum and the median home prices were only off about 2%, I announced on Gold Seek Radio that I expected the housing decline to be the biggest issue facing our nation for the remainder of the decade. And that was way back near the end of 2007. And you know, what was more difficult to foresee, though, was this huge credit crisis that would follow the housing smash. Not to mention the related employment. You know, last year's financial market crash is now being eclipsed by the record unemployment figures, with more than 7% of workers now looking for jobs, and last month's unemployment figure was one of the worst in American history. And you know, I believe that history will look back at the world housing bubble as one of the greatest, at least in magnitude, of all time. For instance, listeners know by now that for 75 years, the median home price never experienced a losing year. Now talk about a bull market. When we say that stocks are in a bullish period, there are usually at least a couple of potholes along the way. Remember the bull market, which began in 1982 and it ran to the year 2000? Can you think of any difficult years along the way there in that period, Bob?
From October of 1988 until June of 1992, it was pretty rough. The real estate market got banged pretty bad.
Of course, don't forget wasn't there the Asian flu in 1997? And, you know, who can forget John Not-So-Merriweather's $2 billion long-term capital management loss in 1998. So even stocks, they stumbled along the path of least resistance to higher levels, but not housing. For 7.5 decades, housing was the bedrock in which the world placed its trust. During the savings and loan crisis and a few other bubbles in maybe Florida, Texas, and California, we did have some regional downturns, but never did we experience a losing year. Now, if we leap forward to 2008, you know, the typical home lost 15% last year. That's on top of 2007's losses. So we had two back-to-back losing years, and I think they'll be very likely followed by yet another losing year in 2009 and 2010 for that matter. And we've discussed ad infinitum in previous shows, the huge pick-a-payment arms which are recasting right now and will continue to do so into 2010. So a total peak-to-trough loss in the median home prices should be at least 35 to 40%. And that assumes that unemployment does not soar above my 10% estimate by the end of the year. You know, now that the housing bubble has burst, the government's response, it was very predictable. Right on cue, the Fed cut rates to the lowest in history, to practically zero, and now they're flooding the banking sector and car manufacturers with cash. But the housing and stock market bubbles are not reflating. You see, officials are finding it practically impossible to inflate housing and stocks. Imagine the markets as a big party balloon, filled to capacity, but another fresh lungful of air pushed it past its bursting point and suddenly pop. The remains of the balloon are scattered around the room. You can try to tape the balloon back together, but do you think it'll ever hold air again? And I think this is exactly what the government is trying to do. Refill the economy with easy money.
I think you're right in saying that, and I think that they are going to be dreadfully unsuccessful, as we know from classical economics, and that's what's taking the forefront now, that the Keynesianism has messed everything up with its advocates. $1 trillion, 800 billion stimuli in the marketplace is not going to last more than 6 months. They'll be back in a year for another trillion and another trillion and so on. And it's an insolvable problem unless the whole system is purged. And that's the important point. And they're not allowing that. Wall Street, banking, insurance, major international corporations are being saved by government and the Fed, which is essentially the American taxpayer. The legacy banks are all bankrupt. Most of the major brokerage firms are bankrupt, not officially, but they are. The derivative structure hasn't even been approached yet, and it's in the hundreds of trillions of dollars. No, this is not going to come to a conclusion in a very short period of time. It's going to take a long time. You cited the pick and pay loans, and then we're going to have another group of loans in 2 and 3 years from now that are being set now by FHA, which are the same as the Alta and subprime loans that we tried to get away from that were just set before they caused a problem. And they're doing it again. And so this is going to be ongoing, and they think, the people who are running things, that by extending this, they're solving the problem. And of course, they're not. It's not going to go away, and it's just going to make a depression. And I believe we've already entered into depression. I think and incidentally, I called recession 2 years ago next month. And I think that instead of this thing lasting 3 or 4 or 5 years, it's going to last a lot longer. And I think that's terrible.
Yeah, I think you smacked the cover off the hard ball here. You know, people, do you think they care about lower interest rates on home mortgages? I mean, they realize that the economic bubble has burst, and they're using whatever meager funds that they have left to pay off their debt, to build up savings, not to spend on wasteful things which don't help their bottom line, like a new McMansion or a second home or a condo on the beach or a Hummer. So, you know, the stock market and the housing bubbles have burst. Where then is the next bubble going to form? The only markets left standing are commodities and government bonds. Gold, for instance, has held up remarkably well compared to almost every other asset class. Also, short-term treasuries, i.e. T-bills, remain within a powerful uptrend. I mean, just take a look at the T-bills exchange-traded fund, the ETF ticker symbol, BIL. Or you can look at SHY, and you'll see one of the most impressive bull markets around. In fact, it's one of the only few left. Also, type in SHY ticker symbol on a weekly sharp chart, and you'll notice the lack of volatility right away. For instance, a typical losing week in the ETF for bonds might bring a 1/4 point decline. That's a bad week, or maybe a 1/2 point at most. That's a tiny loss compared with almost any other asset class out there, like Google, for instance, or, you know, a comparable stock at $80 or $90. You could expect many, many points loss, maybe 5, 10, 15, 20 points or more if a bad earnings announcement were to be reported. You don't have that as a major concern when you invest. Also, there is a 5% dividend, almost 5%. The bond ETFs send out their dividends every 30 days, every month, instead of every 3 months. So when you buy one of these ETFs, you'll receive a near 5% dividend yield with very low risk of volatility on your capital, and you'll receive a paycheck every month. I know there's many people out there yawning right now over 5%, but you know, just a year ago, stocks, commodities, when they were roaring higher, 5% would have put the toes to sleep on most folks. But you know, in a period where prices are deflating at such a rapid pace, low volatility with a big dividend yield, or you might think of it as a monthly paycheck, I mean, that's very enticing. Plus, you can be sure that the government bailout money will more than likely continue to pour into short-term bonds for much of the rest of this year. So wrapping up here, Bob, you know, eventually the T-bill bubble will burst as well. At that point, I expect hundreds of billions of dollars entering the short-term treasury market to flood back into gold, silver, and energy-related investments. So there you have my forecast. I believe the key to the next leg higher in commodities will be the end of the treasury bubble. Once investors realize that the momentum trade is over and the carpet is pulled out from under T-bonds, the money will flood into the only asset that can protect during periods of wealth destruction, and that's gold, silver, and energy. Looking into my massive 40-inch dual mirror telescope here, I see the government bond bubble bursting when the greenback rally ends. The dollar, you see, has been soaring thanks to the mad dash for cash in the credit crisis, plus the global central bankers' desperate attempt to devalue their currencies against the dollar in order to insulate their economies from the global recession. The Bank of England dropped its rates recently to the lowest level since the 1600s. In the Eurozone, well, they're doing the same thing. Once these foreign central bankers have dropped their rates as low as they can go, the pound, the euro, the yuan will once again become favorable currencies. And I think that's the point when the dollar takes its swan dive. So in summary, I expect the dollar to wrap up its rally in the second half of 2009 or early 2010, and that will sound the trumpet that the bond market bull is dead and gold and silver will begin their ascent. I just talked with Doug Casey and Greg McCoach, and they're forecasting $3,000 to $5,000 an ounce on gold. Greg McCoach, who's been spot on since the beginning of this market, expects $2,000